Hello and welcome to another edition of the Smaulgld Subscribers Sound Off. And today I have with me Keith Weiner, CEO and founder of Monetary Metals. Now Keith has some very important news to bring to us today, and we're going to get into that a little bit later on in the interview. First, I'm going to introduce Keith and learn all the things that Keith has been doing in the gold space and get his views on the prices, the valuation of gold and silver, and just general usefulness of gold. And he's come up with a very clever way of unlocking that value. Keith, how are you doing today?
I'm doing well. Thanks for having me on the show.
Well, I really appreciate you coming on. And we do have, and just so our listeners know, most of my listeners know me as somewhat snarky in pointing out a lot of the fallacies in the gold pumper community. Keith is also a very level-headed person. He's pro-gold, but he doesn't share a lot of the gold pumper stories. And while Keith and I have not spoken in the past, we have shared similar tweets where you can see us both shaking our heads on Twitter at some of the stuff that the gold pumpers come up with. But in any event, Keith has some very interesting news for us. So Keith, first, before we get to your very interesting news about Nevada introducing gold bond legislation, please tell us a bit about your background, how you got involved in the precious metals space, and what your company, Monetary Metals, does.
So I was your classic computer nerd. Went off to computer science school, dropped out. I got bored and I wanted to build a software company, which I did. And I happened to sell that software company, which was called Diamondware, to Nortel Networks, August 19th, 2008. That happened to be the last acquisition that Nortel ever did. It was probably, I researched it, and I knew several other companies that were in the process of being acquired whose acquisitions didn't close. I'm pretty sure it would be one of the last acquisitions anybody did, because obviously within a couple of weeks after that, the world began to collapse. Nortel had their announcement, I believe it was September 2nd, so less than 2 weeks after they acquired my company, they announced the wheels are coming off. Rumors started to swirl about their bankruptcy. That turned out to be entirely true. They declared bankruptcy in January of 2009, so 3-4 months later. And watching all of that, here I was. I had just sold my company. It was a cash deal. I was sitting with 100% cash in a couple of too big to fail banks. And at first I felt like I'm just in this amazing position. But as things started to grind on into October and then November, I realized something very, very, very serious is wrong. And I felt like a moth drawn to a flame. I just was studying and reading everything I could 7 days a week. 7-8 hours a day, just to try to understand what was happening and figure out how to protect myself. The deeper I got into it, I started to realize, the nature of the problem, and decided pretty soon thereafter that I wanted my next venture to be in the gold space. If it was a normal world, I would have done another software company. I had built a great team that followed me literally to hell and back. I had access to capital, I had great advisors, and no shortage of ideas. And my team was sitting there saying, almost on a weekly basis, hey, Keith, when are we going to jump and do the next company? But I decided gold had to be part of the solution, and I wanted to do something there. As I continued to study, I realized that what we need is to not go back to the gold standard, but go forward, as I like to say, to the gold standard. And that means you have to ask the question, what brings gold into the market? What makes gold circulate? And the answer to that is interest. Interest is the regulator of flow. So I like to say to people, would you lend me your gold? I'll pay you 0%. Will you lend me your gold? And of course, what people say is, not only do they say no, they say, what gold? They won't even acknowledge having any. People have been hiding this stuff from their governments and frankly from their next door neighbors for 5,000 years. I gave a talk at, there was a club here in Phoenix called the Phoenix Roadrunners, and they're literally prospectors that every weekend go up into their hills and they look for gold. Now I know they find it because at the beginning of the meeting they gave away 3 nuggets, one to somebody who contributed to the newsletter, one to somebody who was really helpful to newcomers, and a third one, I don't remember what it was. So at the beginning of my talk, to make this point about hiding the gold, I said, and there's 300 people in the room, by the way, and I said, raise your hand if you have gold, some gold, any amount of gold. Not a single hand went up. And I said, there you go. I said, you're among friends. You know that I'm the founder and president of the Gold Standard Institute, fighting for the gold standard. I'm founder and CEO of Monetary Metals. You know, there's no federales here in the room, and yet nobody wants to acknowledge having any. And that's been true for 5,000 years. And so when you read an estimate about how much gold there is, the World Gold Council says some 180,000 tons or whatever the number is, you cannot inventory it. People hide it. It disappears down every nook and cranny. And there's only one force in the known universe that will pull the gold out of hiding, and that force is interest.
Now, they'll pull it out for interest, but won't they also pull it out for higher prices?
It's not really circulation. It's basically somebody ending their speculation. They bought it at a lower price, hoping the price would go up, and then the next speculator takes it over, hoping the price will continue to go up. But it isn't circulation, and that's exactly where we're today.
Okay, let me ask you a question then. Go ahead. About where we are.
Any number of companies now are starting to offer the service to let you spend your gold. And I've been saying for years, and I've said it on phone calls with the CEOs and founders of these companies, that nobody, I said, I think a lot of people would be happy to be paid in gold, but I don't think anybody wants to pay out their gold. And so I think gold doesn't circulate, but the reason for why it doesn't circulate is not for lack of an internet-based payments mechanism. I think the reason why it doesn't circulate is people don't want to spend it.
Okay, so let me ask you a very general question, and then we'll get into the Nevada legislation. What gives gold or any currency, Bitcoin, silver, value? Is it the spending of it in the circulation, or is it in the hoarding of it, or is it both?
So it's an interesting question. I think the first fact that has to be acknowledged when it comes to gold is that virtually all of the gold ever mined in 5,000 years of human history is still in human hands.
Okay.
A friend of mine, Philip Barton, wrote a book called The Dawn of Gold, in which he argues the Neanderthals were pulling gold nuggets out of the stream beds more like 12 or 13,000 years ago in Europe. But however long it is, we've been accumulating this stuff. There's no other commodity that we can accumulate more than a few months worth of buffer before it becomes a glut. And everybody knows this law of supply and demand. If you have a glut, then that's a signal to producers to stop producing. It's a signal to consumers that, hey, it's on sale, consume more of this stuff, and then you work the glut off. But after 5,000 years of continual production, we're still accumulating more. And so there's something different about gold. And that's what I just introduced right there is really sort of the start of approaching this as a science. What is it that's different about it? Why are people willing to continue to accumulate it without any particular limit or any known limit? And that is that and this is controversial. So what I just said before is a fact, and nobody really can debate that. The next thing I'm about to say is very controversial, and that is that people value the next unit of gold the same as they value the previous. Whereas for all other commodities, even here in Phoenix in the summer, it can be 120 degrees. Suppose you're wandering through the desert, and you'll be dying of thirst within less than an hour, and you come across somebody who has bottles of water that he's selling out of the back of his pickup truck. What is the first gallon of water worth? It's worth your life. You'll be willing to empty your wallet, you're willing to empty your bank account, because if you don't, you're going to die. What's the second gallon worth? Well, that's enough to maybe hopefully get you back to civilization. What's the third gallon worth? Well, that's a spare. What's the fourth gallon worth? Probably zero. And so the value of the next unit is rapidly declining relative to the previous unit, and by 4 units of water, the value is zero. This was the insight of Carl Menger in looking at the so-called paradox of water and diamonds, is what's called marginal utility. And so my contention is gold has a marginal utility which does not decline, or if it does decline, it declines so slowly that we mere mortals here on Earth can't see it. And so that is what, of course, that's exactly the characteristic you'd expect money to have. That, as you get richer, the money doesn't become worth less. If the money's becoming worth less, then it's not money, then it's something else, right?
Well, there are examples in history where that, for example, during the 1849 gold rush, as gold came east, the value of it went down, and there's examples when silver went from the Brazil and from the New World to Spain, the value of the money went down because they weren't valuing the additional because they were flooded with it. But in your example, I guess the way we mine gold today, we never really have a 10-fold, 20-fold increase in the amount of gold coming online in a given year or a given month. I suppose there is a point where an additional amount might cause that scenario not to be true.
I think it's the circumstances of that additional amount coming on. So if you're talking about the Spanish conquistadors, the circumstances of that are very interesting and need to be looked at. But basically, they strip mined the country for enterprising, productive young men and sent them into this endeavor of war. And so that meant declining production of everything else. So was it simply the increase of gold that came from the New World, or was it simply the collapse of production, and production collapses, which is what you see in Venezuela today?
Or a combination of the two.
If you destroy productivity, then goods actually become legitimately scarce, and that's not a fall in the value of money, that's a rise in the prices of goods, which gets into a whole different thing. I argue you can't measure the value of money as one over the price level, but a whole different thing. But no matter how you slice it, gold has this unique property, and nothing else comes remotely close except silver, that we accumulate it without limit. And any other normal commodity, whether it's crude oil or copper, other things that are relatively durable, I'm not even talking about food, where, if we get more than 4 or maybe 6 months worth of inventory buffer, it's a glut and the price, crashes.
So hoarding of most commodities in large amounts will lead to a decline in the value of the price. And you're saying that, I believe, that when you hoard gold, there's no adverse impact because each ounce that's added to the pile of hoard gets added at the same price. It doesn't decline in price.
Yeah, that's right. And just think about the practicalities of it. So gold, if I want to have, let's say I'm a blue-collar worker, I've been working for wages my entire life, and I take the entire value of my sum total of my savings when I hit the age of 65. If I want to hold that in gold, that'd be a couple of bars that I could put in my pocket and walk down the street.
Right.
If I wanted to do it in silver, which would be the next most interesting commodity to talk about, that would be a stack of fairly large, like sizes, bars that would be the size of a loaf of bread. And if I were to try to do it in copper, you're talking about a flatbed truck.
Right.
And so and then if you're talking about oil, you're talking about an Olympic swimming pool full of oil, which also happens to be toxic and sticky, and it decays if it's exposed to either sunlight or oxygen. So then you need specialty storage for it, and then when you start storing it, of course, it gives off vapors that are flammable and toxic and so forth, so you really need specialty facilities to even hold it, whereas gold is the thing you can put in your pocket, if you want to, and of course, throughout history, people did.
So now that we understand the concept that hoarding, at least in precious metals, doesn't impact the price, because even though you're taking it out of circulation, use that caveat for a second, taking it out of circulation, it still has the same value because it's really not circulating at all in the first place. So it's valued as something that people want to hold rather than spend. Is that correct?
Yeah, today nobody wants to spend it because, of course, people have an income in dollars or pounds or euros. So you get a dollar income. To spend gold means you have to buy gold and pay the offer price, and then you have to sell the gold, which means accepting the bid price and taking the loss, which is 1 or 3%. So today, gold is used as a store of value, and maybe as a speculation, people think it's going to go up, but there's no spending of it because nobody has a gold income.
Okay, now let's move this to the real world. Now, this is groundbreaking stuff. This is a potential game changer. This is stunning. Keith, tell us what you did, how you applied your thinking, your rationale, and your work to this new Nevada legislation that enables gold bonds.
So the background to this is that I've been arguing, I think for about 8 years, that in order for people to want to move to the gold standard, it has to be in their financial interest to do so. And I don't mean that the gold, as you call them, gold pumpers, buy the gold and then the price goes up and then they're happily just hoarding their gold because everybody's desperately needing something that can use this money. There has to be a practical here and now proposition for why everybody would want to move forward to the gold standard. So
let me just underscore the point. If those are the only people that want the gold standard, the gold holders, because they want that one-time gain, I think your point is going to be there's very little impetus behind that because there are not that many people who have gold.
no, that's right, and it's also pretty transparent and pretty, in financial world that would be called talking your book.
Yeah,
So you buy the gold
special
and-
interest, right?
Yeah. So there has to be an actual value proposition that makes sense. So I built monetary metals on the idea that we pay interest on gold in gold, and so to the investor, we don't have to talk about Yellen or Bernanke or now Jay Powell and the Fed and money printing and the debt and all these things. We just say we'll pay your interest on your gold, and it becomes a pretty simple conversation and a pretty commercial one without all the economics baggage. But they're also so it makes sense for an investor to invest in gold, obviously, especially if they're getting a yield, because that yield isn't being debased by the Fed. The Fed has on its website, it states its goal officially is 2% debasement per year. So if you're earning 2% interest and the Fed is taking away 2% of the value of the money, then you're taking risk. It's a return-free risk. But if you're getting a yield in gold, then obviously the Fed can't debase the gold. Right. So, but there also has to be a proposition for why anybody would want to issue a gold bond. And so I wrote a paper that I submitted to the Wolfson Prize in Economics, not expecting to win, knowing I had zero chance of winning if I talk about gold. The Wolfson Prize is the second biggest award that an economist can win after the Nobel. And I argued in this paper that basically we have three goals that we have to accomplish, or urgently, desperately need to accomplish. And that is, number one, we have to pay off all the debt, at least in nominal terms. And most gold people would say, oh yeah, we'll pay it off using inflation. But I argue inflation is the process of borrowing more. Yes, the value of the money may go down, but you owe more of it. In fact, you owe exponentially more of it. You can never get out of a hole by digging it deeper. Number two, we have to ensure the solvency of the financial intermediaries. That's not just the banks, but that's also the pension funds, the annuities, and insurance companies.
Right.
And for that matter, employers. And if there's a default, then that means everybody loses potentially 100%. Jobs are lost, everything shuts down. There has to be a way of preserving solvency of all these parties, again, in nominal terms. And then thirdly, you have to get gold and silver to begin circulating. And so I proposed this idea of this gold bond. And I proposed one twist, that the issuer of the gold bond, when they sell the bond, should not be selling this bond to raise dollars. In other words, to buy the bond, you don't give over dollars to buy it, nor are they trying to raise gold. You're not giving them gold to buy the bond. Rather, you're giving them outstanding paper debt. So you're saying this is how many paper bonds I will redeem and give back to you in tender for this gold bond. So what that does, so there's an interesting dynamic there. This is a system that will move in a certain direction. If you think about sort of game theory and the rules of how this works. So right now there is obviously a paper dollar to gold ratio or exchange rate, which is currently about, what is it on my screen right now? 1256. 1,256 paper dollars will value 1 ounce of gold, spot price right now.
Okay.
There will also be a exchange rate set up between the paper bond and the gold bond. Initially, I expect that will be 1-to-1. So if the government is going to issue 1,000 ounce gold bond, and when I say gold bond, I mean a bond denominated in gold with principal and interest payable in gold. So completely outside the realm of the dollar altogether. So they're going to sell a 1,000 ounce gold bond, and you have to redeem outstanding paper bonds in order to buy it. If that's a 1,000 ounce bond and the price is 1256, then I would expect in the first auction of the first issuance, $1,256,000 worth of paper bond would be redeemed, right? That would be, a one-for-one or par trade of the one bond for the other. However, what I expect will happen relatively quickly, and we see this in our own marketplace within monetary metals, is with each deal that we do and we publish the results, the market gets smarter. And in this case, if you're talking about a 10-year bond, that means dollars payable over 10 years, with the Fed promising all the while to debase those dollars at 2% per year, and gold being paid out over 10 years, and gold is not debased. So what you'd expect to happen is that in the second auction, the paper debt will come back at a discount. That is, people will start to say, well, wait a minute, $1,256,000 payable in 10 years isn't worth $1,256,000 today. It's worth less than that, and so you'd have to bring more than that amount of debt to tender to get the gold bond, and so there will be a rising gold bond to paper bond exchange ratio, which means that the issuer, in this case Nevada, will be able to get out of debt at a discount. It will be able to pay off its existing debt and replace it with gold-denominated debt at an exchange ratio that's increasingly in the state's favor.
So way I see this is a true gold standard, because you're moving from paper standard over to really a true gold standard. Is that correct?
Right. You're remonetizing gold, and you're replacing irredeemable debt with gold redeemable debt.
Right. So you're moving from paper debt to gold debt.
Right. And in the case of Nevada, you have a gold income to back it up. So the state of Nevada has a 5% tax on the gold mining that occurs within the state. There's approximately 166 tons of gold produced in the state every year. Mm-hmm. Now, as I understand it, it's not just simply 5% of that, because it's 5% of the net gold produced, and that takes out certain costs, I think smelting and other costs like that. But the state has tons, literally several tons of gold income with which to amortize and literally extinguish its gold debt.
Could you also do this with silver, given that Nevada has significant silver mines?
Absolutely, and in fact the legislation names both gold and silver.
Ah, yes, the name of the act is the Nevada Gold and Silver Enabling Act. Now, can you tell us how you pitched this, who you spoke to, because that's probably an interesting backstory, and how this legislation might roll out?
Well, I think I'd probably better not talk too much about who's talking to who and what relationships with who. But the way I think, so this is right now just introduced as legislation. Obviously the next critical step, there's several steps in making legislation. It has to be assigned to a committee. It then has to get out of committee. The committee has to agree to pass it to the floor of the General Assembly. The Assembly would have to vote it up. It would then have to go over to the Senate and get assigned to committee, and that committee would have to vote it out of committee and into the floor, and the Senate would have to vote it, and then it would have to go to the governor.
Now, did you provide white papers or some type of documentation for Assemblyman Marchant to use to buttress the case for his introduction of this legislation?
Yeah, I mean, I've been discussing this with him and several other folks for some time, and then of course the interesting thing, or the good thing, is I've been producing a body of work for quite some time to refer back to, including that paper that I submitted to the Wolf's Enterprise, talking about the mechanics of it. I was also, and so there were some other materials I developed. A couple of years ago, the Arizona House of Representatives created a committee on gold bonds and named me as a member of the committee, which is interesting because I'm not a member of the Arizona House, right. Not a politician. And so I had a slide deck that I produced for that, and there was a paper that came out that was ratified by that committee, and my testimony is on video. So if you go to the Arizona House website, that video is hanging out there somewhere. So I've put together a lot of material talking about this from the practical benefits to try to appeal to the CFO or the treasurer, say this is why it's in your interest to do this.
Now, I
And so
have the
Nevada,
article, The Benefits of Issuing Gold Bonds, on your website. Was that one of the documents that the Nevada Assemblyman looked at?
that was so we had brainstormed a series of arguments, and that article came out subsequent to this whole thing sort of moving forward. But that was the essence of all those arguments. And the state of Nevada is looking at not just as a way to get out of debt at a discount, but generating jobs and industry within the state, and opportunity, increasing the gold mining sector. And it's also good for the mining workers, mining workers unions, and the pension funds, both the mining pension funds and the state pension fund. Like most of them is underfunded, and there's some excitement about the idea of putting a gold bond into a pension fund.
Okay, so what I have now, and I'll put the links below, I have the benefits of issuing gold bonds. I have Nevada introduces gold bond legislation, which includes the link to your paper for submission for the Wolfson Prize. I think that'll give our listeners a good starting point to digging deeper into this. Let's move on. Now, congratulations on that. I think just even getting people talking about it, having the attention of a assemblyman is very important. I do like the concept. Where do you see, absent gold bonds taking off in this fashion, where do you see the gold market heading?
So right now, obviously, it's sideways. And sideways has both ups and downs. So we track at Monetary Metals a model-based, econometric model-based formula for what we call the fundamental price of gold. So most people, when they talk about the gold fundamentals, they're talking about is India or China buying, or is there going to be a strike in South Africa or something like that.
Okay.
But we just look at those things as just gold from moving from one corner of the market to another, and that's not really what drives the price. So we have our own theory based on the gold basis, and have a model that tracks where we think the price ought to be or would be if speculators in the futures market were mathematically removed from the price. Where would the price of gold be? I can look at it right now. Just give me one moment here. So I gotta pull this up.
Okay.
Oh, I should have just gone. I have a special thing that I look at. I should have just gone to our homepage, which has it right on there. Fundamental price as of yesterday, $1,300. Right?
And
So
how have you tracked your fundamental price with the regular price over time and come up with a over under on that?
Yeah, so we backtest and we publish our fundamental price going back. We've licensed a full, what's called tick history database from Thomson Reuters, which gives us every bid and every offer in every futures contract and spot going back to 1996 with sub-millisecond resolution. The database is approaching something like 4 terabytes. And so we backtest and we publish on our website what a chart of the fundamental looks like for that 22-year period. What's interesting about the fundamental this year is that there was a big blip up in the fundamental, starting basically the beginning of the year. So from October through Q4, fundamental was going down, and then just about almost exactly January 1, it really shot up from to zoom in here a little bit, the vicinity of 1250, it shot up to well over $1,500. But by the end of April, that had peaked. It's literally been every day coming down,
Yeah,
It's now at 1,300.
I'm looking at the chart now.
And
You're
so
closer together.
something happened to drive up the demand, and then that thing like turned off like with a switch, and then is coming down now. And we can debate the why, but what we can say, what was not debatable is that there was a rising scarcity of gold from January through April, and now that scarcity it's like letting the air out of the balloon. We can debate why the air is let out of the balloon and who might be letting it, but what I can say is that the physical product, or the physical market for particularly retail products, is absolutely moribund, and anybody can verify this themselves by calling up their favorite bullion dealer and asking for the bid price. Say to the dealer, I have Eagles, or I have 1 ounce PAMP bars that I want to sell you. What's the price that you'll pay me? And in some cases, they're offering less than spot.
Yes, we discussed this last night. Not only are the newly minted coins not selling, it's because also what demand there is, it's moving towards the used coins and used bars, and the dealers are able to offer those to their clients at near or at spot because they're paying less than spot in many instances to the people that are selling to them. Now, what do you say about people who say that all this chart stuff and looking at gold prices, it's all rigged anyway, and that there's this grand conspiracy to rig the gold and silver markets perpetually lower?
Well, it should raise a red flag if somebody says you can get away with a conspiracy in perpetuity or years or decades. There's an old saying, I don't know if this is from Sicily, but I suspect it is, that the only way, only a dead man can keep a secret or something like that. And then there's another one that, if you tell one person you have a secret, but if you tell 2 people, everybody knows. The idea that thousands of people could keep a secret like this just doesn't ring true. But if you look at the market and you look at the market data, and we have the data to do this, I think we've written more to debunk the idea of a conspiracy manipulating the price than anybody, and we show our data. So we make an argument, and we say, okay, whenever 2 theories contradict one another, and that could be Einstein arguing with some other physicist, saying that we're going to find some super duper pulsing quasar, and Einstein says that light is going to bend to the left when you find one of these things, and Lorentz, just let's say, argues light is going to bend to the right. So that's going to now be the test case to see whose theory is right, because they have different theories, but that's the one case where you can find the theories predict opposite results. And so all of physics obviously sits on the edge of their seat until decades later somebody has enough money to put a telescope in space, and then they find one of these super duper pulsing quasars, and they say, aha, light bends to the left. Einstein was right, Lorentz is wrong, and then the world goes on. And so you need a case. So I have a theory that says the futures price is, or the market makers are arbitraging between spot and futures. The other theory is that the futures market is used to suppress price. There's a case where my theory and that theory predict opposite results, and that is when a futures contract reaches expiration. In my theory, the speculators that were long in the market have to close their long position.
Right.
So they have to sell. They have to sell their expiring. In the next few weeks, they have to sell their August gold contract, because if you hold that past about August 26 or 27, then you have to put up the cash and buy the actual gold. And if they don't have the cash, they have to sell August, and then they can buy October or December. The other theory says that banks are naked, and so the banks would be the ones with urgency who would have to buy their way out of the contracts. And so this now gives a testable case. What happens to each of these contracts? Do they get sold down? In which case you would expect the basis to fall, and the near contract could even tip into backwardation. Or is it the banks buying them, and the basis would rise and rise and rise? So we published a graph. It took a little bit of jiggling to get everything to fit on the same page, but we published a graph showing the expiration of every gold contract and every silver contract going back to 1996, which is the oldest data that we have, showing the behavior of that contract. And so this article came out. We just produced the data, and we're thinking about how do we show this. And Ted Butler, famous silver conspiracy guy, had said, put himself in the position of the elder statesman, professor emeritus, and said, well, I put my theories out there, and I submit them for thoughtful disagreement. So I said, okay, we'll take you up on that. And so we wrote an article, and I think the tone was very respectful, but said, and the title of the article is called Thoughtful Disagreement with Ted Butler. And so we publish the explanation of what I just said with a little bit more detail, and then we publish the graph showing that, sure enough, every futures contract, the basis falls, the co-basis rise, which means it's being sold down, which means it's the longs who have to get out with urgency, not the shorts. The shorts aren't naked. It's actually the longs that are naked. The longs are betting. The shorts are market makers. They're arbitraged. They buy physical gold and then sell a future and pocket the spread, which is called the basis. And so we put the data out there. The graphs are there. And then I would say the same thing that Ted Butler did. Anybody who reads that and who disagrees is free to disagree and say why. Interestingly, we didn't get any of that. But we got some pretty aggressive attacks. I woke up one morning and Gata had a headline that was like, Weiner doesn't want to see this, or whatever it was. I was like, oh, that's interesting. I'm a one-name guy now in a headline, and the headline is about what I don't want to see. But all that aside, I publish what I see. And what I see is the contract behaves in the way that it behaves, and you need a theory that explains why it behaves that way, and the manipulation theory would predict the exact opposite of how it behaves.
Well, so it sounds like to me that it's the structure of the market and the contracts that leads to this, and the market participants acting in a rational way based on how the structure of the market is and how the contracts, that when they roll over and so on, or what they choose to do. But that does give some credibility to the theory that the introduction of a gold and silver's futures market itself was designed to be manipulative without them actually having to interfere or hold the steering wheel.
So, in a very broad sense, yes. So we went...
Knowing that this is how it's going to work out based on the way you've analyzed it, then it works like a charm.
I mean, we went in a period of several decades. We went from when gold was obviously money to 1971, gold is demonetized. It's banished from the monetary system with Nixon's infamous decree. By the way, the video of him announcing the closing of the gold window is on YouTube. For anybody who hasn't seen it, you got to go look up and watch Nixon, the most mendacious, lying sack of you know what. But anyways.
Bugaboo is my favorite word in that speech.
Bugaboo, that's right. So it's demonetized, and you go through a period of a couple of years where everyone is sort of expecting it to be remonetized. I mean, even the villains in that story, and the more you research it, even the villains are like, is that it? I can't believe we got away with that. Is it that easy? They're going to let us get away with it? Like, that's kind of where they're at. But by 1975, they legalized, so gold had been criminal for American citizens to own.
Right.
After 1933, they re-legalized it in 1975. And then shortly thereafter, the futures opened up. There shouldn't be a futures market of gold.
Well, that's the point. That's the point.
I don't mean because it manipulates the price downwards, but in a free market, gold being money, if you want to talk about the future value of gold, that's an interest rate market, not a futures market.
Correct.
It's not a futures price, it's a bond market.
Right, because I think that's why they introduced it.
That brings us full circle to this Nevada thing, and there will be others, is that a bond market cements the role of gold as money, as the extinguisher of debt and the denominator of debt, and that's how people in a free market behave. Whereas what we have right now is obviously we call it fiat money. It's money because they tell you it's money and they have a gun. That's the tragedy of the whole thing. It's very un-American.
Speaking of un-American, it's the 4th of July. We can't have any of that. All right. Well, Keith, thank you very much for joining me. Can you let us know how can we track the updates on this Nevada Gold and Silver Enabling Act? I guess, should they go to your website, monetary-metals.com? Is that the best place?
Yeah, if you go to our website and then you hit subscribe, there's a red button in the upper right. You can choose to subscribe. We break it down, so we have these weekly reports and blog and all these things. But you could just track the news. And so anything that's happening on the gold bond front will certainly be a news item. Obviously, you can follow me on Twitter, and you can follow my tweets as well. But I think this story is going to get legs. It's already been published all around the world: mainland China, Hong Kong, Switzerland, Germany, the UK, Australia, Canada, and it's being translated into other languages. I've already seen German and Dutch. I think the story is going to get legs. And to your point about the gold pumpers, there's a really interesting thing here, and it's subtle. But right now, for most of, certainly speaking for Americans, it's different in the rest of the, very different in the rest of the world. But speaking for Americans, we love gold for jewelry,
right,
or for watches, cufflinks, or things like that. But as far as anything monetary or financial, I think the average American either doesn't think about gold at all or kind of scoffs at it. And so the introduction of a gold bond is a paradigm shift that gets people starting to think about gold in a true financial context, not as this metal that you bet on its price.
Right.
Which is what
it's effectively a remonetization of gold.
And people will begin to think of it in those terms. And so, number one, I think when the actual bond is sold, it's going to be oversubscribed. But for every person who wants to buy the bond, I think there will be 100 who think of buying gold in a different light from the way they think of it today.
Exactly.
And I think the introduction of this bond is going to begin an uptrend in the price of gold. Now, for people don't know me, I argue gold doesn't go up and it doesn't go down. It's the dollar that goes down and up, and down over long periods of time, but it can go up. Obviously since 2011 it has. And so I think the dollar begins its decline again, but what I'd like to see is not the collapse and the end of the world and the so-called reset. I said to people, you should think of 476 AD when you say that word reset.
Right.
But it needs to be a graceful, controlled descent, with a relatively safe landing at the bottom. And then as gold begins to be remonetized, it becomes obvious to people that, gold is better money, and the dollar isn't even really money anyways.
Well, that's a better exit than the barbarians at the gate in the fall of Rome. I mean, you have a remonetization of gold, extinguishing of a lot of paper debt, and without the inflation.
No, right. And I was going to say, think about that extinguishing mechanism. That is going to maintain a bid on the paper bond because it's there to be tendered or exchanged or redeemed for the gold debt.
Correct.
So it doesn't collapse in this crazy catastrophic event to zero.
Right.
It goes away, but it's retired under controlled circumstances. And I argue in this paper that you're giving everybody a link to that once the state of Nevada breaks the ice, it's really the concept of breaking the ice, that there will be other issuers of gold bonds that will come forth to the market, because then it will be proven that there is a market. I think one of the biggest fears, if you're a company or a government that has a gold income and somebody were to suggest to you, hey, you should sell a gold bond, I think one of the biggest fears that they have is there really a market for it? I mean, what if we go to all the effort of trying to produce and sell a gold bond and there are no buyers? And then everybody would be terrified of that, and whoever pushed for that would lose it most likely. And so we need to show the world, no. It's the other way around. The buyers are unlimited, and right now there's no supply. The demand is unlimited and there's no supply. Wouldn't you want to be a supplier in a market like that? And once they see that, and hopefully Nevada proves that, then you'll see a lot more issuance of a lot more gold bonds, and that's a sea change.
That is a
that's how the
game
world.
changer. That truly is. And I hope it comes to pass. And I'm going to leave links so people can educate themselves on this. This could be the start of a very big trend in the monetary system. Keith, I want to thank you for bringing this to our attention, for all the hard work that you've done. And let's see if it happens. But thank you very much, Keith.
Thanks. Alrighty, thank you.